Atomic Habits is not a finance book, yet few ideas explain long-term financial success more accurately than its core premise. Small behaviors repeated consistently compound into extraordinary outcomes. Financial success rarely comes from one perfect decision, a lucky trade, or a sudden breakthrough. It comes from habits so small they feel insignificant in the moment, yet powerful enough to shape decades. When applied to money, the philosophy of Atomic Habits reveals why most people struggle financially, not because they lack opportunity, but because their daily systems quietly work against them. The first lesson Atomic Habits teach about money is that behavior beats intention. Many people want to save, invest, or build wealth, but their environment and routines make those goals fragile. Financially successful individuals do not rely on motivation. They design systems that make good behavior automatic and bad behavior inconvenient. This might look like automating investments, separating spending accounts, or removing friction from saving while adding friction to impulsive spending. The habit is not be disciplined, but make discipline unnecessary. Over time, this structural advantage compounds far more reliably than bursts of willpower. Another critical insight is that identity precedes outcome. Atomic Habits emphasizes becoming the kind of person who does something rather than focusing on the result itself. Applied to finance, this means adopting the identity of a saver, an investor, or a long-term thinker. Financially successful people do not wake up asking whether they feel like managing money today. They act in accordance with who they believe they are. I am someone who invests every month is more powerful than I want to be wealthy someday. Identity-based habits create consistency even when emotions fluctuate. The book also explains the importance of tiny gains over dramatic change. A 1% improvement in saving rate, a small reduction in unnecessary expenses, or a modest increase in income invested rather than spent may feel trivial. But compounded over years, these choices dominate outcomes. Financial success is rarely visible early because compounding is slow at first. Most people quit during this phase. Those who persist do so because their habits are small enough to be sustainable. They do not aim for transformation. They aim for repeatability. Another atomic habit relevant to finance is environment design. Spending decisions are not made in isolation. They are triggered by cues. Advertisements, social comparison, convenience, and emotional states all shape financial behavior. Successful individuals redesign their environment to support their goals. They unsubscribe from marketing emails, avoid constant portfolio checking, surround themselves with financially responsible peers, and make long-term choices easier than short-term indulgence. These changes are not dramatic, but they remove hundreds of small leaks that drain wealth over time. The concept of habit stacking also plays a powerful role. Financial habits stick when they are attached to existing routines. Investing after every paycheck arrives, reviewing expenses once a week with a coffee, reading financial news only during a specific window instead of constantly. These small routines create rhythm. Over time, money management stops feeling like a chore and starts feeling like part of life's structure. This is how financially successful people remain consistent without burnout. Perhaps the most important lesson in Part 1 is that bad financial outcomes are usually the result of invisible habits, not bad intentions. Overspending happens through small justifications repeated daily. Lack of investing comes from procrastination, normalized over years. Debt grows through convenience, not crisis. Atomic Habits reframes these patterns without blame. It shows that changing money outcomes does not require radical sacrifice. Only small behavioral shifts applied patiently, because the true power of Atomic Habits is revealed not when money is scarce, but when progress begins to appear. This is the stage where many people quietly sabotage themselves. Success introduces temptation, complacency, and complexity. Part 2 is about how small habits protect financial growth over decades and prevent the common collapse that follows early wins. One of the most important applications of atomic habits in finance is maintaining discipline after success. When income increases or investments perform well, the temptation is to relax systems. Spending rises. Investing discipline weakens. Risk tolerance expands without awareness. Financially successful people counter this by reinforcing habits precisely when they feel least necessary. Automatic increases in investment contributions. Fixed lifestyle ceilings. Scheduled financial reviews that happen regardless of performance. These habits act as guardrails, preventing success from undoing the behaviors that created it. Another critical lesson is the role of feedback loops. Atomic habits thrive when progress is visible and reinforcing. In finance, this means tracking behavior, not just outcomes. Net worth charts, savings milestones, or habit trackers that show consistency rather than returns. This shifts focus away from market noise and toward controllable action. Financially resilient people celebrate consistency more than performance. This keeps motivation stable even during downturns when results are temporarily discouraging. The book's emphasis on systems over goals becomes even more powerful at higher income levels. Goals create finish lines. Systems create continuity. Financial freedom does not come from hitting a number. It comes from living within systems that produce freedom indefinitely. People who reach a net worth target without systems often drift or regress. Those who build systems experience freedom as a byproduct, not a milestone. Atomic habits turn wealth from an event into a condition. Another subtle but vital application is habit friction management. As wealth grows, financial decisions become more complex. Taxes, investments, family obligations, and opportunities multiply. Financially successful individuals simplify aggressively. They consolidate accounts, create clear rules for spending and investing, and outsource decisions that do not require personal judgment. Reducing friction prevents decision fatigue, which is a silent destroyer of long-term discipline. Simplicity is not laziness, it is protection. Atomic habits also explain how financial identity evolves. Early on, the identity may be, I am learning to manage money. Later, it becomes, I am someone who protects optionality. Eventually, I am a steward of capital. Each identity shift supports different habits. What remains constant is alignment between identity and behavior. Wealth lasts when people continue acting like builders, even after building is no longer urgent. Perhaps the most overlooked lesson is how atomic habits support emotional regulation. Financial mistakes rarely come from lack of knowledge. They come from stress, boredom, fear, or overconfidence. Habits like limited portfolio checking, predefined decision rules, and regular reflection reduce emotional volatility. Over time, this emotional stability becomes a financial advantage. Those who manage emotion through habit rarely make catastrophic errors. When viewed as a whole, atomic habits reveal that financial success is not about intensity, intelligence, or timing. It is about consistency under changing conditions. Small habits protect against both failure and excess. They scale with income. They survive boredom. They endure success. And this is where the lesson ultimately lands. Big wealth is not built by big changes. It is built by small decisions, repeated faithfully when no one is watching. Atomic habits turn financial success from a fragile achievement into a durable system. Those who embrace this approach do not just accumulate money. They build lives where money works quietly in the background, supporting freedom, stability, and peace over the long arc of time.